Hello, everybody. This is Noah Rosenblatt. That is John Walkup. We are Urban Digs, and today we got James Nelson. We got ourselves some James Nelson. We have interviewed James before. He is the principal and head of Avison Young's Tri-State Investment Sales Group. That is a full-service global real estate firm. It has 5,000 professionals, 120 offices, 20 countries. John, this guy is wicked smart.
Yeah, I mean, more than that, though. I mean, James, you've been in the business for almost 25 years, I suppose, at this point now. You've done like 500 deals, 5+ billion, I suppose, in deal volume. I mean, you've got a team of a dozen professionals under your belt. So we are really looking forward to what you have to say today.
Yeah. Yeah, we're
Well,
in good
wonderful.
hands.
I truly appreciate the opportunity to come back on again. So obviously the first time went well enough that you said, all right, we'll give this guy another shot.
Squeaked by.
But really appreciate all the content. As a fellow podcaster, I know how much goes into these shows, and just so thank you from the community for all the valuable content and what you all are doing. Especially, I know we're going to get into the market, and there's a lot of mixed signals out there, and so the data and information that you provide is hugely valuable.
Thank you, James.
Thank you.
That is awesome to hear. And you're on the other side, right? We're on the residential side. You're on the commercial side. We don't really talk about that often, but we really do want to know what's happening. So we're going to start out broad, James. If you could tell us what is the state of the commercial real estate sector in New York City today?
Wonderful. So definitely a question that I get multiple times per day. And I always say, look, it really depends what and where, right? Because when we talk about commercial, and I'm on the investment sale side of the equation. So we go out and sell properties. About half of what we sell are multifamily, mixed use. We do retail. We sell office buildings. We sell development sites. We sell a little bit of industrial here in New York and across the country. So those asset classes, and I know we're going to get into it in each of those asset classes in more detail, but just kind of broad brushstrokes so you can understand what's happening here in New York with investment sales, and we're talking 5 million plus. Okay, right now we're still tracking at about only a third of the 10-year average as far as dollar volume. So in a typical year in New York City, there's about $35 billion of sales. Last year, we were only at about 10. This year, maybe we step up to about 12 billion in trades. Peak of the market, if you're going back to 2015, when the Moon Star, everything was in alignment, was close to $70 billion. But again, volume has come down tremendously. Why? If you look back to middle of last year, when interest rates started to rise at an unprecedented rate, and you all know about the impact and what that's done in the residential space, but for investors, what that was, not only putting downward pressure on pricing, because a lot of buyers finance their properties, and then they go, it allows them to acquire more properties and hopefully get some benefit. Certainly they were receiving that pre mid 22, where they were even getting positive leverage when you could borrow money in the threes. And then once that shot up 5.5%, 6% money, not only did that put downward pressure on pricing, but worse was the uncertainty. And you all remember kind of end 22, even earlier, last year, how long is this going to go on for? We have this unprecedented rate increase after rate increase. And how long is this going to go for? And so what happens is buyers and sellers alike move to the sidelines, because buyers say, well, I'm not going to buy into this thing. If rates keep going up, there's going to be more downward pressure on pricing. There's going to be distress. Investors love distress. I'm going to just wait. And I'm going to wait and see if I can buy at the absolute bottom. And meanwhile, sellers are saying, well, I'm not going to sell into this if I don't have to. I'm going to wait to see if once we bottom out and maybe get a little bit of an upswing. Now, some sellers don't have that option. And when you read the reports of, loans coming due and banks in some cases taking back properties, sometimes, the sellers don't have the option to wait. But the discretionary sellers certainly on the sidelines, and the buyers, especially the big institutions, have largely been quiet as well. I think that's about to change. We saw Blackstone made a major acquisition, $10 billion, basically took over another company, Air Communities, that own a portfolio of multifamily on gateway cities, New York included, which I think is a big vote of confidence. So we're starting to see some of these big institutions that are sitting on a ton of dry powder saying, we're going to get off the sidelines, we're going to jump in. I think, Noah and John, if we just get one rate cut, And not that that'll make a huge difference to the economics, but what it does is I think it makes a big difference to the psychology of the market, where buyers will say, oh no, I missed the bottom of the market. It's turning, let me jump in. And sellers are saying, okay, now we're kind of headed back in the right direction. So, obviously a lot of chatter. Are we going to get at least one cut before the election? Maybe two. We'll see. I certainly don't have the crystal ball, but I do know that I think if we do get one of those rate cuts, it's going to make a big difference.
Wow. Awesome start here. And let me just tell you, this is so interesting because we were just talking about this on Macro Monday on Monday, John and I and our whole audience there. We feel like we've been in a volume trap for everything that you've been describing, this volume trap, this both sides going on the sideline. And the uncertainty level, we feel like we're saturated with uncertainty right now.
Yeah.
And once you get past that potential rate cut, which is September, is what the markets are now expecting. Maybe December is the second one. But once that uncertainty goes down, those guys on the sidelines probably will come back in. So it's just really interesting to hear it from you in a different perspective and how we've been talking about it on the residential side.
Mm-hmm. Yeah, there's no doubt parallels between residential and commercial and with the buyer psychology. And I would say another similarity is with cash buyers. And you certainly see that on your side, where a lot of the purchasers today are saying, hey, I don't want to borrow money at 6.5%, 7%. I'll just buy it cash. Maybe I'll finance it later. And we're certainly seeing that on the commercial side as well. We're seeing that especially with a lot of foreign activity. There's been a huge uptick in foreign investment. In fact, we just signed our 10th deal with a Japanese investor, separate Japanese investors. They're coming here and largely cash buyers.
Huh.
We're certainly seeing buyers come from all over the world, but they're able to move. And while a lot of the traditional domestic buyers are on the sidelines, the foreign buyers are saying, hey, New York's on sale. Let me jump in.
Interesting. I mean, a lot of that has to do with interest rates and the idea that there's a little bit of distress coming down on the pricing side. But other than that, what are some of the other challenges that are facing New York City commercial investors right now?
Well, we could certainly talk about post-COVID, hybrid, and what that's done to the office leasing market. So when we talk about commercial, I kind of address that talking about investment sales, but many would think about, the headlines with what's going on with the office market. So here in New York City, we have 450 million square feet of office. The vacancy, or excuse me, the availability rate. So availability rate is what's actually vacant right now, and then what's available for sublet. Right now, the availability rate is 20%. Okay, so we've got close to 100 million square feet of office space in New York that's not spoken to right now. And, we'll see with hybrid work, and we know, finance is coming back 5 days a week. Tech, not so much. So we'll see where this lands. The return to office, if you look at REBNY's, the Real Estate Board of New York's numbers, is in the mid 70% range. And again, very specific. What you don't want to do in this market is generalize. So, return to office is very different in industry, but also submarket. Grand Central is doing really well. People want that commute with Metro North, Madison North opening up. That certainly helped with getting the Long Island commuters into Grand Central. So that's helping. Financial district, a lot more challenging. Maybe you all are seeing that on the condo side. So yeah, there's a lot of office space that's not spoken for. Now, what we're watching is what happens with these office to resi conversions. And before, there wasn't a lot of them, only about a half a dozen that we had tracked. Why? Sure, zoning is part of it. So you have to have the right zoning to go from office to resi. You also have to have the right floor plates. Some of these don't have the light and air. But look, if you buy it cheap enough, I mean, if you look at 25 Water Street, which is almost a full city block, they took two major light wells and cut out the middle of the building to make it work. But they had bought the building for around $200 a foot. So, that's not where office in Midtown is trading. But now, and Albany came out with a huge housing package. And part of that was, yes, a new 421A, which is now 485X. But part of it was also a tax abatement for office to resi conversion. We think that's going to help as well. So clearly, you all know there's a huge housing shortage, 1.4% vacancy, rents going through the roof. If we can convert some of this office to resi, that's certainly going to help alleviate that demand for residential and solve for some of this office space that is antiquated.
Are you
Abatements for office to resi.
Yeah. Sorry, go ahead. No.
No, I just wasn't even thinking about that. I keep thinking about the feasibility economically of these projects, and then I didn't think about the potential abatements or something that could make that work.
Yeah, hats off to Albany. Actually, they came up with a really great incentive program. It is a 35-year abatement, and it's substantial too. Your taxes will end up at 10% of what they would be otherwise for a as built completed residential project. So you're paying 10% taxes. And that's a big incentive.
Yeah. Wow.
Now there is trade-offs.
Huh.
Obviously, you have to include 25% of the units have to be affordable,
Right.
but it works.
Yeah.
And
It's a changer.
are you finding interest on the property owner side to start looking more into this as a result of some of these bills being passed?
Certainly the more sophisticated developers. I mean, the existing owners, if you're sitting with an office building and you've been an office operator for decades, you probably don't have the experience or maybe the ability to do that conversion and understand it. So, we'll see what happens. Either, maybe some of these office owners now sell because the residential market becomes strong enough, or maybe they end up joint venturing and saying, hey, I'll partner with someone. Some will obviously try to figure it out on their own. But it is pretty challenging taking an office building and converting to residential.
Yeah. All right. I'm looking at my next question here, talking about more specifically on the state of retail, multifamily, and office. So I got that. And then I look at my questions from our users here and I see this question. So I think they're tied together. With 2019 legislation and now good cause eviction legislation, what impact are you seeing in the multifamily investment sales? So if you could potentially talk about that and then sneak in what you're seeing on retail and office, that'd be great.
Great question. So part of that New York State housing package was good cause eviction. Okay. So what that applies to are buildings that were built before 2009. Okay. So newer construction are not subject to good cause. What does good cause mean? When you go to renew a fair market tenant in that building that's before 2009, now you can only raise the rent by CPI plus 5%. So right now, call it 9%. So you can make a 9% increase as long as that tenant is in possession. The tenant vacates and it's fair market, you can charge whatever you want for that apartment, provided that it's fair market. So that's good cause. Now, regulation is not a positive thing for investment, right? If anytime you put guardrails, you put a cap on what you can charge in the free market, it's not a great thing. However, in this instance, I think that a lot of the institutional investors said, we're not buying New York multifamily until we know what the rules are. I don't know if you all remember, but at one point they were talking about only giving 150% of CPI. CPI gets down to 2-3%. All of a sudden you can't raise your rent 3-4%. That becomes more problematic. 9%, great. Most investors will say, sign me up for that. If I can increase my rents 9% every year, that's great. And by the way, based on the California system, and a lot of the institutional investors say, okay, we understand. We know what the rules are for the next 10 years. Once again, just like interest rates, uncertainty is not a good thing. Once we know the rules, okay, we got to apply the numbers, but we at least know what it is. Now, the first part of that question refers to what happened in 2019. That was what took existing rent regulation and basically removed the potential to decontrol those units. That has had a major negative impact, not only on the values of rent regulated buildings, but I think on the affordability. And again, we could spend a whole hour talking about how when you freeze rents, that you would think, oh, well, that just makes everything more affordable. Well, no, because then what you're doing is taking away the incentive for new development, for renovating those buildings. And it's crazy. I don't know if there's the current number on it, but I think there's somewhere between 20,000-30,000 apartments just sitting vacant. Because if I have a tenant who's paying $800 a month and they vacate, and again, we could get into all the math, they only give you enough credit to basically raise the rent by, call it $100. Who's going to go and spend $50,000 to $100,000 to renovate an apartment, which is what it costs to get that minimal of an increase? So what do? They just leave the apartment vacant. So that's still a challenge, and they tried to make some revisions to it in this latest housing package. I don't think it's enough, but we definitely need more housing. Last year there was only 15,000 permits filed for new units. The city says that we need 500,000 units by 2030 to keep up with demand. REBNY says, I think, 530,000 units. So maybe for another show or for another idea, I went out to Jersey City a couple of weeks ago, and it's booming. I mean, they're building everywhere there because, New York, it's impossible to find an apartment. So that's multifamily. I mean, retail, I think, is a totally different proposition because it's not regulated in that sense. And I think a lot of investors who said, I don't want to, deal with all these changes. I'd rather just be able to, rent the store. And we've seen a huge resurgence in retail, and not just on High Street, but, a lot of the neighborhood retail that's out there. And the yields have gone up too. So again, if you're borrowing money at, 6% now for a commercial, for a retail investment, you're going to be able to get over a 6% return. So you can do that now. Those returns 5 years ago were in the 3.5% to 4% range. And I think there's still a lot of upside potential because a lot of the retail rents have still not gotten back to where they were pre-COVID, even though that the foot traffic numbers are back. You look at tourism numbers, they're back. So we're really bullish on retail.
So can I summarize it like this, generally speaking, and bear with me? Retail and foreign investors coming back and and alive again, and multifamily and office still kind of dead, or in the
No, that
okay.
might be a little severe. I mean, I would say retail is certainly performing very well. I think multifamily, there is certainly interest in fair market product. There's healthy demand. We are transacting that space. Fully regulated apartment buildings, yes, that's very challenging. There's not a lot of buyers for that, right? For office interest, right? Is that interest dead? No, there's certainly buyers out there. In fact, it amazes me that one of the largest buyers of office in New York is also one of the largest owners of shopping centers, B&C shopping centers across the country. So talk about a contrarian play. Just bought 529 Fifth Avenue on 44th Street, paid $105 million. It's under $400 a foot. That's probably a third of what the building was worth 5 years ago. So you have speculators at a certain price. But where I think what's been really exciting to see is a lot of end users taking advantage of this market and stepping up and buying office for their own use. Okay. So, Prada and Gucci Prada paid $850, Gucci upstaged them, paid $900. I mean, those were really retail driven deals they bought, but Prada did have an office component. We think back, you look at when Hyundai bought the Tribeca Film Festival building for, I think, $275 million. There's companies that are actually buying office, which could also be, we talk about office to resi conversions being one way to, solve this office issue. End users also stepping up and buying their spaces is also a way that we're taking some of this office space for lease off the market.
Interesting. So, James, I mean, there's so much stuff that I would just absolutely love to dig in there. And, one of the things I'd like to talk about is you mentioned the idea of regulation and guardrails, especially around, the multifamily. And then you talk about, how retail's coming back, but it's not the same as it was, right? You're seeing some low rates in other places, some higher rates in different places, and it's a lot of change happening. Same thing on the office side. And I'm curious, when you put all of this together, is it still possible to sort of, compose a portfolio now that beats where the interest rates are and beats inflation as it's coming in?
Yeah, I think retail for sure. One thing that I've noticed certainly now is investors do not want to take on negative leverage. I mean, I remember 2006, 2007, when, by the way, you were borrowing money at 6%, but back then investors were buying at 3-4% returns because they thought the rent growth was going to be so substantial that that would kind of make up for that negative leverage. Today, investors are saying, okay, that movie didn't play out so good. We want at least neutral leverage. So they're solving for cap rates that are in line with what you can borrow today, or even getting positive leverage. So I think absolutely buying retail. I mean, there's credit that you can buy out there today at a 6.5 cap. I think that's a pretty amazing opportunity. Some investors saying, I'm going to buy cash. I'm going to hope that interest rates go down, and then I'm going to refinance it, when that happens. And again, with retail, it really depends also what kind of increases that you have to keep up with inflation. But there are ways to set that up so you can try to guard against that. Office investment is a totally different. I think one of the biggest challenges as an office investor is it's not just the buy-in price. It is the price to lease up these assets. It is so expensive to secure office tenants today, right? They'll pay maybe a decent face value rent, but talk about concessions. You all talk about concessions when people rent apartments. I mean, the concessions for office tenants could go on for years, right? They get free rent, sometimes a year at a time. The amount of TI, tenant improvements that the landlord is paying to attract the tenant. Hey, I'll build out this beautiful space. Sometimes it takes these office landlords 3+ years to recoup their investment back on a 10-year lease. So, a lot of the office buying that I'm seeing right now, I hate to call it speculation, but they're buying it on a cheap price per foot. They're hoping that the office market comes back, and maybe 2 years I go and I resell it. Probably not putting a lot of money into these assets now because, again, it's so expensive to lease them up.
Yeah.
I have one quick follow-up, James, and this is just sort of a quick aside. I'm just wondering, on the residential side, there's a lot of talk about price per square foot, but it sounds like, and you've mentioned this before, I just want to drill down into it. If you could give us a quick summation of what cap rate is and how you use it and how universal it is in commercial, that'd be, I think, very helpful to a lot of folks.
Great question. And first of all, we do use price per foot as well. We use both, price per foot, especially when we're talking about a vacant office building or half vacant. There probably is no cap rate, right? But the cap rate is the rate of the return the investor's looking for before debt service. So you're just taking the top line revenue on the property. You're taking out the operating expenses, okay, real estate taxes, utilities, management, repairs, and then you're solving for a net operating income, NOI. You divide that NOI by the purchase price that you paid. That gives you the cap rate, right? So if I'm solving for a 6.5-7% return, but I'm borrowing money at, let's say 6, then I'm getting positive leverage. I'm borrowing money at less than what the return the property is given. So that's the way to look at it, kind of on face value. And then we can get from there, we can get really fancy. We could talk about IRRs and what does it look like over a 10-year period. But I think a cap rate for a tool comparison is the way that most investors first consider, certainly a retail investment, a multifamily investment.
Thank you.
James, I got a question here. And by the way, guys, we got James for about another 20 minutes. Guys, take advantage of this time. You got a Q&A here. Please put your questions down here. He's given us this time, and this is an intelligence show, guys. So I don't want you guys to leave here without asking what's on your mind. James, what do you think of that Pfizer conversion to residential? I don't know about it, so.
Yeah, I've only seen what I've read in the paper, and it's look, we've just said how much need there is for residential. So certainly with these new incentives, I think it's interesting. I think we're going to see a lot of these higher profile office deals look for conversion. But again, it's looking at the building and what is actually required. Do the floor plates line up? Does it have the right light and air? I mean, there's a lot of questions that come along with it. But, I think there's demand for residential everywhere. I mean, we're right next door to a condo development on the corner of 5th Avenue and 44th. I mean, I don't know what you would think of that traditionally as a residential condo location, but there's selling condos very well there. And it does seem to me that there's certainly more demand for it. So would not surprise me that a conversion for the old Pfizer building would be a good move.
Interesting. So I've got another question here from a user basically asking, as a residential broker who works with a lot of foreign buyers, what's your advice in getting commercial investment sales brokers to work with me on behalf of my clients? And I think you talk about this in your book. And so a quick book plug, Insider's Edge to Real Estate Investing. But not, I mean, this is like it is a how-to guide to be. There we go.
Thank you.
There we go.
I
This
just
is like
started
the
this
how-to
book.
guide.
Good.
I mean, it's an amazing book. So I'm just wondering if you want to touch on that, because I know you talk about building teams and basically how to sort of, position yourself for success in this market.
Yeah, I love that question, and I'm working on a white paper right now called A New Vision of Brokerage. It's really the vision of brokerage that I can't take credit for, because going back 25 years ago with Massey Knackle, and the idea that, hey, when we go market properties, we want to share it with the whole world, which means the brokerage community as well. We can't possibly know who all the buyers are in the market, right? And yet whoever submitted that question, I'm sure, is dealing with some frustration where they'll call some of the brokerage firms. Maybe they're not even getting a call back. Or if they do, they say, oh, go get your fee from the buyer, or, really challenging to get that information. I mean, as residential, if you hired me to sell your property and your apartment, and I said, oh, don't worry, I'm going to just send it to my direct buyers. We don't need to co-broke. They'd say, are you out of your mind? But that happens with commercial. A lot of the commercial inventory is not out in the marketplace. It's not on LoopNet. It's not on Crexy. A lot of the brokers kind of keep it in-house because they say, well, we don't need to send it out. We know who the buyers are. We can send it out direct. So you have that buyer and you're saying, well, where's all the listings? I see all these deals selling, but I don't see them posted anywhere. Now, that's also when we talk about the insider's edge to real estate investing. It talks about how inefficient the real estate market is. And that's why if you're an investor, that's a good thing that it's hard to get information and find these deals, because if everything was out there in the open, pricing would be a lot more efficient. So unfortunately, this part of the reason why I'm writing this white paper now is because it shocks me how little the brokerage landscape has changed in the 25 years I've been doing it. We're still out there sharing, and there's certainly broker-friendly commercial brokers. And if you look at like the Massey Knackle family tree, and you look at all the 18 different firms where we ended up, you call one of those brokers, and not to say that there's not other commercial brokers out there who work with residential brokers and share fees, but a lot of the other places you go and you don't get the information. So we use that as an advantage. In fact, we just won a very high profile sale assignment for a block front in Soho. And we said, day one, we're going out to the brokerage community. We're letting the whole world know, and we're cooperating, right? And so we want to remove all the friction. So you call up, we say, look, these are our listings. No, there's no pocket listings. There's nothing hidden. Go to our website, go find it. Unfortunately, that still does not exist with some of the shops that are still out there.
Yeah, really interesting. I got a couple more questions here. Let's hit you with these, James. See what you got. What cap rates in Jersey City versus New York City multifamily? Any idea there?
I'm just starting to get smart on this myself, because taking a hard look, it's not that far off. In fact, New York cap rates can sometimes be a little higher than Jersey City. And you say, wait, that doesn't make any sense. Isn't New York, again, lower cap rate means an investor is accepting a lower return, paying a higher price, right? So, but Jersey City, again, if you have a more pro-business type environment, they have rent regulation, but it's not as heavy. So, the cap rates that I'm hearing about in Jersey City are in the fives. It's a newer market. I mean, one thing you do have to look into is that supply and demand. So New York is really difficult to build in. We'll see now what happens with this new 45X. But the fact that the reason why our rents are so high is because we have a lack of supply. And again, I'm not an expert in multifamily sales in Texas or Austin, but just anecdotally speaking to some of my clients who said, oh, these are growth markets. I'm going to go down there. I'm going to buy. And a lot of investors were buying up these deals at 3% return, saying, oh, I'm getting double-digit rent growth year over year. And then I call one of my friends. I said, how's it going? He says, not so hot. I said, well, why is that? He says, my rents are going down. Well, I thought everybody in the whole free world is moving to Austin. What's the issue? He says, well, too much supply, too much of a good thing. When you have no barriers to entry where anyone could go in and build, then all of a sudden it's like, oh, wait, because cap rate, there's two pieces with the equation of value. You got the rate of return, but also obviously where the rents are, right? The question with Jersey City, and I don't know how much you all have dug into this market, but there's a lot of units under construction there. So what happens to rents when they add another 15, 20,000 units? They might be absorbed within months. So, because they're getting clearly a lot of overflow from New York, but we'll see. That would be the question in my mind.
All right. Because this next question, again, so we're just kind of going through the questions the users have posted. This next question sort of follows that, which I think tags on the idea that it's difficult to build in New York. So we're seeing a lot of conversions. And the question is, what's the best, most interesting thing you've heard of recently for the alternative use of office space? And I guess I would add my own twist to that and ask you, how much imagination do you need to come to a deal with as a commercial broker in imagining these alternative ideas?
Yeah, there's certainly imagination, but the first piece is the zoning, and it's really technical. New York City zoning, the handbook, I think, is like 700 pages, and we talk about, oh, you can go to Texas and just build whatever you want. I mean, New York, yes, we have as of right zoning. It's very specific, right? But you have to understand what you can and can't do. So do you have the proper light and air? Are you in an area that allows residential? Right now, the city is looking to pass the City of Yes plan, which is going to allow you right now in some areas, you can only convert office buildings that were built from 1968 or before. They're going to bump that up to 1991. So now all of a sudden you have all these buildings from the 70s and 80s that you can convert as well. That's going to bring a lot more opportunities. So as a savvy investor developer, you need to understand, where are these rezonings happening? Where are they going to allow for this? There's a rezoning that's being proposed right now in Midtown South. So you can look at some of these areas that were previously commercial. They're now going to give you the ability to go residential, right? And so that's for us, yes, vision, does it have high ceilings? Does it have light and air? But we're looking at the zoning and saying, is this feasible? As far as creativity, one thing that we're watching closely, part of the City of Yes, is that it used to be that you could only have commercial below residential. And now, and again, this is where we should play the disclaimer, talk to your attorney, talk to your architect. But there are ways now that you could actually intermix commercial, residential, commercial, residential. Obviously, you have to have the right amount of, separate fire safety and all of that. But I'll give the city credit that they're trying to be more flexible to allow for these conversions.
Awesome. Another question here, is the CRE refi cliff coming in 25, 26 a risk for both office and residential demand?
Wow. Great question. And depending what numbers you look at, if it's, $2.5 trillion of debt coming due in the next 5 years, it is absolutely going to cause challenges / opportunities if you're looking to invest. I missed this part at the beginning, which is a really important distinction. If we have very low sales volume, well, who's selling, right? A lot of our clients who are bringing product to market, they have a loan coming due and they have equity in the deal. Let's say they bought the building for $100 million and they had $65 million of debt, which, 5 years ago, 65% loan to value, no problem. Today, it's not just that rates have gone up, but lenders have also become very conservative. So what they're saying is, well, hey, we'll extend your rates going up. And oh, by the way, you're going to have to pay down your loan $15 million because we want you at 50% loan to value. Now, that's just to give an example, but we're seeing this, time and time again where, hey, you want to refinance, you got to pay down your mortgage. So you have equity left in the deal, but you have to make that decision. Am I going to pay down this mortgage or am I going to sell? Right. And so that's driving a lot of the sales activity. Now, office, that's multifamily, where again, most of these deals still have equity in them. It's just this deleveraging that's happening. Some of these office deals are just totally upside down, where, you borrowed $200 million and the property's worth 150. There you just say, okay, here's the keys. Hopefully, the discussion with the lender is, okay, I know we had some, guarantees, personal guarantees, let's not do the whole litigation thing. I'm just going to give the property back to you, just let me off the guarantees. And so that's when you see a lot of these situations happening. Generally, borrowers are just saying, hey, we're so far out of the money, we're just walking away from this.
That's interesting stuff. So I want to come back to that a little bit, because I mean, there's a question about, what's the process to get a variance, and some of these sort of more tactical things. But I kind of want to wrap it up. There's another question about the difference between investor friendly stuff like Florida, Texas versus the Northeast. And I'm curious, in your opinion, I mean, I think of the New York City commercial market as basically having this governmental moat around it, which makes everything much more difficult than it would be in some of these other states that you mentioned, like Jersey City, Texas, Florida, et cetera, where, oh, you want to build something? Great, go ahead. Just put a, fire extinguisher in the corner. You're good to go. It's not the same here. And I'm wondering, in the long run, is that actually investor friendly to make it so much more difficult? Or is it a burden?
It's a great question. And first of all, before I hit that, I want to just quickly, with the variance, I would not recommend. The variance process in New York is a very arduous, long, drawn out process, 2 years. And usually when you do that, there's going to be huge trade-offs, with affordability to do that. There's so much to be done right now that's as of right. You don't even need to be looking into variances. So just, what you need to do is get smart on what rezonings are currently being proposed, track those, find out the new conditions for conversions. So that's that. But as far as, do you invest in a market that has all this regulation that has, hey, if you own existing multifamily that was built after 2009, this has been unbelievable, right? I mean, your rents are going through the roof because there's a lack of supply. So if you can figure out how to get something built, it becomes very valuable because it's so difficult to build. So, but then again, if you're on the wrong side of that, where you're also getting hit with the regulation, where now your rents are capped or they change the rules as you go along, and that has happened before. Remember that whole Stuytown ruling where, DHCR said, okay, well, we've kind of changed the rules here and what we need you to do. And there's a lot of investors who say, I'm just not willing to deal with that. I'd rather, you hear about how challenging it is to get a project done here, how much time it takes to get through landmarks, to get a C of O. Whereas you go to the Carolinas and you get the building plan examiner showing up to the project. Hey, how can we help you finish this project? Let's get this thing on the, the tax roll. Right. So it really, it's a really interesting question because there's positives and negatives associated with it.
James, are New York City office buildings subject to the Green Energy Local Law 97 that residential buildings are subject to?
Oh, for sure. Yeah, that's really what the program was designed. I mean, these office users are some of the biggest consumers of energy. Look, we all agree that we need to do a better job with sustainability, with carbon emissions. But to me, and I'm certainly not an expert at this, but when I heard that the building on Bryant Park, Bryant Park, which is like a LEED Platinum, would be penalized. I'm thinking, okay, somehow that the math or how they're calculating this doesn't work. And I think the challenge on the office side is it actually penalizes a building if you have a trading floor in there and you're working 24/7, right? And you're dense and you have a lot of people there, and it could be the most green building, but because you're using that energy, you could be penalized for it. So it is a major concern, consideration. Also, with a lot of these new requirements requiring the electrification of buildings. Again, great idea. Can the existing power grid support it? I don't know. From what I've heard, very challenging. So, I think sometimes these goals, it's great, but you need to make sure that you have the alternative energy available to make those benchmarks.
Right, James, I've got a question here. It's sort of specific questions about the cost to convert, like if you got a residential storefront, you want to convert it, what the cost is. And I want to sort of wrap that into a larger question about your your sort of data diet. I mean, there are a lot of programs. I mean, you mentioned the zoning code. I mean, how many pages it is, and I know that there's programs out there like Envelope, et cetera, which can kind of give you an idea of what can be built on a specific space. And I'm curious how you stay on top of all of the data that's coming in, not only on the regulation side, but on the price side. And I'm just curious what that day looks like for you in terms of ingesting and digesting all this data.
So another great question, and this is really one of the first parts of the book here. We talk about this is a business of specialization. And so sure, that information is out there. And do I try to follow the trade publications and meet with the city and hear what these proposals are? But at the end of the day, it's having good zoning counsel that you can reach out to and say, what's your interpretation of this? What do you think? And also spending a lot of time with the real estate board in New York. I mean, they do incredible work for the industry and for the city to make these projects work because, again, government can come up with all these programs, but if the numbers don't work, no one's going to implement these incentives. So they get really deep on the issues and figure out, okay, how do we all make this work? And so we do spend time, but a lot of these things also, sometimes the answer is not black and white. I mean, you have with the housing plan, there's a lot of room for interpretation, which means, well, how's that going to happen? Well, someone's going to have to take it to court and say, okay, well, what do you think about this? And then they will continue to make amendments to the code as we try to figure this out. So, but the key again is having great professionals that you can rely on. Because I know enough to be dangerous, but these are really technical issues, and that's where you need to bring in the professionals.
Awesome. James, we're pretty much down to the last couple of minutes here, and I got one more question from our users. First off, I want to say thank you, James, for going off script here and touching all these questions that these users asked, and just coming out with it. This user is asking, are you anticipating more distress for office in Manhattan, or are we kind of priced in at this point?
I think we're going to continue to see more distress, unfortunately. I mean, and part of this is how these loans roll, right? So if you have a loan that's not up till next year or the following, you might have a little bit of time. But the other thing is same thing with these leases. You have these leases where they're rolling, and what's happening? Are companies keeping the same amount of space? Are they downsizing with the new hybrid? And so is that availability going to stay at 20%, or is it going to continue to increase? I think it really becomes a flight to quality. So you see that the Class A trophy buildings, the One Vanderbilts of the world are still doing really well. But I don't know, that side street Class B, C, product is going to have some real challenges. And that's why we really need to kind of get aggressive with these resi conversions. But yeah, no, I think more loans coming due, more leases expiring. I still think we've got some more pain to get through.
You know what we need, James? We need
What's
a
that?
good old fashioned capitulation, a good old fashioned purge and
Yeah.
deleveraging, just to puke it all out and
Yeah.
get out of the mess. Sorry.
Well, it's starting to happen. I mean, a lot of it is these banks are able to keep these loans on their balance sheet because their appraisals are always rear view mirror, right? They're looking at, and for a while, like these sale, we saw it on the brokerage side. We're on the front line negotiating these deals. And you're seeing these comps at like, $400 or $500 a foot, but we've got buyers saying, well, I wouldn't pay 200. And then all of a sudden you start seeing, one of these sales come in and we say, oh, wow. And so then, little by little, these sales come through, and then appraisers are able to say, well, hey, this is the new benchmark. And then, the banks have to say, okay, well, we're going to write this down, or what are we going to do about this?
Yeah. I mean, and you talked about this earlier. This is where the psychology of the market starts taking over from the black and white of the numbers, which is, yeah, great. The numbers are coming in here, but the buyers aren't willing to step forward. And it's going to be interesting to see how that plays out. And speaking of the psychology, James, I kind of want to wrap it up because you've been an amazing guest. You've answered a ton of questions. As Noah said, you've gone off script. You did the lightning round. So we got one final question here, which is, it's a two-parter. And that's, what would you have liked to know the first day you started in this business? And the second is, what's your advice for the residential agents listening today?
Wow, those are great questions. I've got to say, starting off, I was really lucky because I had no idea. I mean, having a great mentor in Bob Knackle, Paul Massey, who I remain very close to today and remain in regular contact. I was so lucky. I had no idea. So I think early on, get a great mentor. I also think mentorship is really a two-way street. Don't just expect for someone to just deliver knowledge to you. I mean, most of the learning I did was just listening and watching what was going on. But I think also, and you all asked the question, how do you stay up to date? I mean, I'm a voracious consumer of content, so it's not just, the Real Deal and the Commercial Observer and Biz Now, but I'm listening to your podcast. I mean, podcast, what an incredible thing to get long form content where you can
I love
really
it.
go deep on a topic. I think a lot of it today is everything's sound bites, right? Everyone's flipping through with their reels and it's 30 seconds here and there. But like to really go deep on a topic, there's so much knowledge out there. And what's really cool about podcasting now is I get students who say, hey, thank you so much. I'm listening to your show. It's been so helpful. And what an incredible thing. So hopefully I answered. I don't know if I answered both of your questions. Well, you said what would I like to have known? So maybe where did I miss the boat? You know what? I think I would have started to build a team earlier. Uh,
Hmm.
this business is about having a team doing that. There's no way that I'd be just sitting here talking to you all if it was just me and I'm trying to go sell properties and do all this. I mean, we have a team of close to 3 dozen people and we have dedicated support analysts. I mean, it really research, it takes so for those of you who are kind of flying solo, I would recommend, start off with at least get an assistant, get a junior. There's so many people out there. I mean, we posted for a analyst position and we got 400 resumes for the position. There are
Wow.
so many people out there who want an opportunity right now. Start with an intern. Start with someone who's at NYU Fordham right now, who wants to just pick up 15, 20 hours during the week, right? Because if you can't begin to start leveraging your time, right, it's going to be really difficult to progress in the business. So I would have brought on a junior associate much earlier on if I knew what I knew today.
This has been incredible.
Yeah.
Food for the brain, very satisfying. I feel like I got fed today. So
Good.
thank you.
Well,
This has
I,
been
I gotta,
incredible. Yeah.
I just gotta jump in. I gotta say,
Yeah.
I love that note about podcasts because I remember when I first started working in Wall Street, I remember taking the 4-5 and it was packed and people would have the journal, right? And there's a special Subway fold where it was like, they would fold it. It
Yeah.
was like, only like an eighth wide. They would have this crazy fold. And now it's like I've got my headphones in and I can listen. I can go far deeper than any article could because I
Yeah.
don't have to worry about all these crazy folds and bumping elbows. I'm just listening. I mean, it's a fantastic point. And I hope that people sort of, I actually, James, what I'd like is a list of your podcasts. We'll put that in the notes because
Okay.
I'm very curious what you got.
Wonderful.
Yeah.
Happy to
Yeah.
do it. This was great. I love what you all are doing for the industry, and it's always great to collaborate. So, thanks again for having me.
Yeah, and we
Thank
love
you.
you too, James. And guys, buy his book. All right, Up Your Game. And let me just tell you guys, look for James Nelson out there. Find his email, send him a thank you email. Okay, because this is a relationship business. And if you ever find yourself in a position where you have a commercial situation going on that's timely and you need someone to help, you could maybe work with James. Okay, and maybe he can help you. So, like, that's the kind of stuff that we're talking about. And he's proven today he knows what he's talking about. So, James, thank you from the bottom of my heart. Thank you for coming. That is John Walkup. That is James Nelson. I am Noah Rosenblatt. And this has been Talking Commercial. And we hope you guys have a good one. Cheers, everybody.
Thank you, everyone.
Thank
Thank
you.
you.